go ahead. So everybody hit continue on that. Good morning. All right. Sharon, so let's go. We'll go ahead and get started. Thanks for being here. Oh, hold on a second. Bear with me. I've got one person who's trying to get in and can't find the link. Just a second. Kelly, did you get, and Lisa, you got the link right from Carol?
Yes.
I don't know who I got it from, but yeah, I definitely got it.
It comes from quote unquote Zoom with no specific name.
All right.
On Monday, June 21st.
Oh, okay. And Carol's on it. She's resending. Yeah, I think people are just looking for the wrong place. All right, let's go ahead and get started. Thank you for being here. We'll have other people popping in here in just a bit. We're continuing today with our exit planning 101 conversation. Again, we're trying to understand the what, the why, and how of building a successful and comprehensive exit plan. And last time we were focused on owner-based goals, both financial and personal or emotional. Today we are going to shift gears a little bit and talk about the business value, and because those two pieces, as we've talked about, are critical to having an exit plan. So Corby, let's continue through the slides if we could.
Yep, will do.
Great. So as we've talked about, there are three legs to the exit planning stool, as we would call it. Understanding and maximizing the value of the company, making sure that the owner and the business are both financially and emotionally prepared. And that as part of that emotionally prepared is also having a plan for the next act. And so today we're going to be focused more on the business side of things. And as you've heard us talk about, one of the challenges that comes up is last time we talked about the owner having their own specific goals. Sometimes you have a number, but the idea is to get a real number that is going to support you in the future. And then there's the value of your business. And unfortunately, there's often a gap. And so that's what we're going to be talking a little bit about, and certainly getting a good handle on the value of the business. Corby, if you want to continue from there then, and we'll let Walter take it over.
Thanks, Lisa. So I would just start by, one thing I always do when I talk to clients about valuation is the first thing is just cautioning them that if they think they know the value of their business because they know what a buddy sold us for, that's usually not a solid way to figure out the value of your business. There's a number of reasons for that. One is your buddy could be lying, for one thing. Number two, you never know how a deal is structured. So somebody could say, hey, I sold for $10 million, but it turns out that included giving the buyer $4 million of cash that was sitting in the company, things like that. So you never really know the details. So you really need to figure out the value of your company based on its unique characteristics. So a couple of things that come into play here, even before we get to the specific company features, there are some macro factors that we need to consider. So one is just the economy in general. If the economy is strong, it's generally a better time to sell your business. Right now, there's a situation where there are more buyers of businesses than there are sellers, but it's projected that due to the retirement of the baby boomer generation, that dynamic is probably going to switch, and there'll be more sellers than buyers, which could certainly affect your ability to sell your business. The other thing to keep in mind is that your industry can also have an effect. So industries come in and out of favor, and you certainly don't want to compare your accounting firm to some company that's a medical disruptor. Some of those companies have sold for over 100 times earnings right now, or at least that's what they're being priced at in their IPOs. They normally pretty quickly go down in value, but that's what they start out at. So you just really need to be careful when you're looking at your company. But the thing to really focus on is the specific factors that make your company valuable. So things that can impact that, one would be customer concentration. You know, if your business is really tied to one big customer, that's going to make it risky. That's going to make it less valuable. If your business is 100% or 80% centered around you as the owner, you're the one who is in charge of sales, you're the one who runs the operations, you're the one who does everything, that's going to make it less valuable. That's an owner-centric company, and that's not a good thing. So you always need to be thinking of your company in terms of transferable value, not just value. So you might be thinking, well, I take home $500,000 a year, so my business is worth 500,000 times some multiple. Well, if you have these issues of customer concentration or owner centricity, that $500,000 may not transfer to the new owner. So you really can't think of that as your baseline value. So in summary here, I would just say you need to realize that your company is unique, and you need to get an objective third party to really take a look at the value of your company.
Next slide, Walter.
Yes, please. And we've been talking about in our previous sessions, we've been encouraging business owners to get an estimate of value. Let me just explain that for a moment, because I think, a lot of business owners, when you say, hey, you need a business valuation, they automatically start thinking, oh my gosh, that's a $15,000 to $20,000 investment. And it certainly can be. And if we're talking about a certified valuation, you're probably looking at anywhere from $8,000 to $20,000. But a certified valuation really comes into play in some specific circumstances. So anytime your company's being valued for IRS compliance purposes, which is pretty much limited to gift and estate tax. So for instance, if we have a client who is gifting shares of their company to their child, or we have a client who has died and the business is part of their estate, those businesses will require a certified valuation, because those valuations have to meet very specific IRS criteria. And those are expensive valuations because there's liability associated for the valuator, because there's IRS penalties for overvaluation or undervaluation. And there's just a lot more hoops to jump through as far as a certified valuation goes. But what we talk about, especially in the early stages of exit planning, is really what we call an estimate of value. And I would say this is more of a real world valuation that's done for strategic purposes. So whereas the certified valuation, what the IRS requires is what they call a fair market valuation. And that assumes a hypothetical buyer and a hypothetical seller. When we do an estimate of value, we don't have that constraint. So, we'll sit down, talk to the business owner, and he'll say, hey, I've had a competitor who has been after me to sell me his company for, every year I get a call from this guy. Well, we could do a valuation specific to that buyer. And the advantage of that is we can then identify specific cost savings and economies of scale that are going to be realized by that buyer. So it's much more of a real world type of estimate. It's really something that you would see in the M&A world. So, like where a fair market valuation can be great for certain purposes, it may not necessarily translate to what you're going to get for your business in the real world. The other advantage of the estimate of value is that can really focus on the value builders. So we can really identify what's driving the value of your business and what's hindering the value of your business. And then from a strategic standpoint, you can take that knowledge and use it to come up with a strategic plan to grow your value drivers and grow the value of your business. So, in summary, whereas a certified valuation is certainly required by the IRS in certain circumstances, in the context of exit planning, we're really discussing more of an estimate of value, which is probably going to cost you somewhere around, $2,500 to $3,500, something like that. So it's a much more manageable valuation from a finance standpoint, and you're going to get an incredible return on your investment from a strategic standpoint.
Hey, Walter, can you comment, how often should an estimate be done?
Well, you certainly want one as you start your exit planning process. And then when a strategic plan is put into place, the overall goal of that plan, while it will have, specifics, the overall goal is to grow the value of the business. So we would recommend that you do an update of that valuation annually, just so you can kind of benchmark how you're doing in the strategic plan.
Mhm. Okay, very good. Very good. All right.
You can go ahead and, yeah, thanks.
Yep.
So evaluation methodologies, there's basically 3 accepted methodologies when a business valuation is done. The first one, and one that's not used generally for an operating business, is called the asset approach. So where we see this is, for instance, we do a lot of these valuations where a family has a real estate portfolio, or maybe even just a beach home or something, and they want to contribute that to an LLC and then start gifting it out to their family for estate planning purposes. This would be an asset valuation, because basically, the LLC is not generating any revenue. Instead, it just owns an asset. So it's a fairly easy valuation. You have the asset appraised by a real estate appraiser, and then my job is to place the appropriate valuation discounts on it. And that's basically how an asset valuation is done. You do see them sometimes in asset heavy businesses like manufacturing and things like that, where maybe the business isn't doing so great any longer, but they do still have a lot of assets, and maybe the value of their assets is actually greater than the value of the company as an operating business. So we don't see a lot of that in our geographical area, because most of our businesses are service-based businesses. The income approach is an approach that is predominantly used for service businesses. And I would say, probably 90% of the valuations that I do, we end up using the income approach. And the theory behind the income approach is that someone buying your company, they're an investor. So they want to know what they're going to be able to receive from their investment in your business. So it really comes down to, what kind of return are they going to get? What cash flow is the business going to generate, and how much cash are they going to be able to return to the owner of the business? And there's basically 2 ways of doing this. If a business has been around for a long time and it's kind of reached its period of stability, there's, kind of cost of living growth in the future, no big expansion plans, then normally what we will do is we will capitalize historical earnings. So the idea is that the historical cash flow of the company is predictive of the future cash flow. So we can go ahead and quantify the historic cash flow. Usually you take like a 5-year average, something like that. And then we figure out, how risky is the cash flow? Does the company have some of these factors I mentioned earlier? Is it too owner centered? Does it have customer concentration issues? If it does, it's riskier. There could be factors that make it less risky. It could be larger. It could have a great diversified client base. It could have a great management team. So we go through all that. We come up with a discount, or a risk factor, which is characterized as the capitalization rate. We apply that to the income approach or to the cash flow, and we come up with a value. The other way to do it is, for a company that maybe hasn't reached stability yet, it's still growing, we can do a discount of future cash flows. So it's the same approach, except instead of using historical cash flows, we're using a projection of future cash flows. But it's the same thing. You come up with a future cash flow projection, you figure out how risky that is, you apply a discount rate, and you come up with a value. The important thing about the discounted future cash flow is that a buyer is going to have to believe your projections. So when you're talking about the capitalization of historical cash flows, the buyer is going to be, he's going to be able to look at the history of the company and say, yeah, this makes sense. We're not anticipating any big changes. Things should continue as they have been. When you're projecting out future cash flows, you need to be able to it needs to be believable by the buyer. So one thing Corby's going to talk about later is a big advantage of having strategic plans and cash flow plans and things like that is that if you're going to base your company value on future cash flows, if you have these plans in place and you've been able to hit the goals, then you'll be able to say to the buyer, look, here's what we're projecting. And this is what we've been doing in the past years with our projections. Here's our actuals. And the buyer will say, okay, this makes more sense to me now because historically you've been doing projections and you've been hitting them. These projections are, in line with the others. So I have more confidence that you'll actually be able to hit these numbers.
So Walter, let me just, I guess, ask you, in order for you to be able to, have good numbers from the past and have good forecasts for the future, I mean, you need to have some good financials in place. You need to have perhaps a team, a bookkeeper, a part-time CFO, a good accountant who's really helping with that, right? I mean, if all of a sudden you're like, I want to sell the business, but you haven't had real strong financial management, this is going to be tough.
That's definitely right, Lisa. So, oftentimes when we start working with a client, it could be a smaller business, and some businesses start out, the owner is doing everything, including the accounting. Sometimes they even are doing it on spreadsheets. So, that's definitely not the financial data that you want to bring in when you're going to sell your business. So, the first thing we usually do is we suggest that a company outsource their accounting. We work with lots of great bookkeeping firms who we could refer someone to. We do it ourselves also, but depending on the cost, it may make sense to outsource it. Generally, clients, once they outsource, they're on QuickBooks Online, something like that, which is great. So if you've got outsourced accounting and you've got good books on QuickBooks, you've got your tax return, that's usually good enough for a company with somewhere less than $5 million of revenue. Once you go above that, you're probably going to have your own in-house accounting person. You're going to have your in-house accounting system. At that point, you're probably going to have some type of compiled financial statements, maybe even reviewed. All that is going to add more credibility to your numbers. And when it comes to due diligence, it's going to be a much smoother process. So that's a really great point, Lisa. So the final approach is what's called the market approach. And the market approach is really no different than a real estate approach. Basically you're out looking for comps. So you try to find a company that's comparable to yours. You see what multiple they sold for. Usually companies are sold, for some type of multiple of earnings. And, then you kind of make adjustments. You say, okay, well, my company is a little bit stronger in this area than theirs, is a little bit weaker in this area. And you can kind of get a pretty good idea of what your company is worth. The problems with this approach, and the reason why oftentimes we really can't rely on it, is that it's really hard to get the details. So unless you're really familiar with the company, it's hard to figure out things like, are they owner centered? What's their customer concentration, that type of things. So it's hard to get the real specifics on the company. But if it's a company you're familiar with and they happen to sell, in a time frame that makes sense to do a market approach with them, that could be great. What we often do is we'll use it kind of as a sanity check, because a lot of times what happens is you can find companies that are somewhat comparable, but usually you have to expand your search to include companies that are outside of the current market area, which can have an effect. So usually we use it just pretty much as a sanity check. But I mean, if you can find a company and you really know the details and it fits you, it fits your facts, that really can be the best indicator of the value of your company. So, these are the three approaches. For most companies that we deal with, we're going to be looking at an income approach. Usually, if it's a company that's been around a long time, we're using a capitalization of historical cash flows. If they're still ramping up, we're going to use discounted future cash flows. So reinforcing Lisa's point, this is where, it becomes important to have strong financial records and plans in place where you can show people that you know what you're doing, you've got a strategy, and you're hitting your goals. So Corby, I think that wraps up what I wanted to cover from a valuation standpoint.
Yep, very good. Good. Yeah, so a couple of sessions ago, we touched on just this idea of a gap even. And so say you're working with Lisa and you're working with Walter, and Lisa's got, the financial plan laid out, there's this desired future, and that desired future, hypothetically here, say in 5 years, it's going to take 17 million bucks to keep you happy, content, hitting your goals for the rest of your life. Well, if your current value of your company that Walter places on it says, you know what, there's a gap here. We got to fill in the gap. The question is, how do we get there? And a lot of what I do as a value creation consultant is look to how can we add value to the company to fill that gap. And no guarantee you'll hit it, but at the same time, moving in the direction at least is working towards solving the problem. As Walter alluded to, there are things called value drivers, which some are tangible, some are intangible. And we all know that, when the day is done, cash flow is a primary driver. As Walter said, an investor's buying to invest. They want more money coming to them than they're paying out. So cash flow is king. However, there are all kinds of other things that are intangible or tangible that lend value. And these are 5 primary, quote, value drivers. There are books out there that will list as many as 40. There are, so everybody's got an opinion. And this is kind of where, we've settled on, these are probably the 5 most significant, most impactful. I threw this little paradigm down here. If you ever watch CNBC, there's a show called The Prophet, Marcus Lemonis, and he deals with small businesses, and he uses a paradigm which I find a lot of times business owners get. It's people, process, product, and then obviously the finances. But anytime he's on the show, he's touching on those things and honing in on your problem is the people, your product is good. So as you think about these things, even whatever paradigm works for you, but I find from a communicative perspective for an owner, this is really helpful. So let's touch on these things real quickly. And Walter had alluded to some of them already, but the people, this little graph says it all, I think. As dependence on the owner goes down, the value of the business goes up. Because when the day is done, it's an assumption that if you're selling the business, you're not going to be there forever. So somebody else needs to run it, and the new owner would rather buy somebody that has a team that can run it rather than them buying a job, because otherwise they're buying a job if they're taking over your role. So some questions to ask. Just one, do you have a team? And that team can be a team of 1 if you're a small company, but somebody else that can run it day to day. We have a friend that had a very small company, but in his last 10 years of operations, he could take off to Australia for 3 months because he had a VP of ops that ran the company, and that guy eventually bought the company, but he had a team, and the team needs to be solid. We've all dealt with clients where you talk about their team and they go, yeah, the team's great, except, and then there's this like awkward silence. Well, that's a sign that, okay, this team isn't solid, and a buyer is going to see that, and they're gonna know that. Org chart is clear and complete. Oftentimes an org chart has Bob, Sally, Betty, Joe. An org chart needs to have sales, finance, operations, HR admin. They need to have the roles identified, and it needs to be very clear, because that's what gives confidence in a buyer that the system is actually working well, the people system. And then obviously people in the right seat. It's the Collins, do you have the seats arranged on the bus, and are the right people in the right seats? And then does that leadership actually have growth potential? Because there are operating leaders and there are entrepreneurs. And if a buyer wants to be an absentee buyer, then the team better have the ability to actually grow the business, because that's what any buyer is after, generally speaking. Okay. Operating systems. Operating systems are core to any business, but the simple idea is, are the systems in someone's head, or are they documented? The way we do business. If they're in someone's head, you need that person. If they're documented, almost anybody can do it. Walter alluded to outsourcing accounting. It's a great way to get systems documented because you buy it. You buy HR. Can the company operate without the founder? Key element that if the systems are documented, you don't actually need the owner to run the business. So, we've encountered business owners where they're absolutely proud that, boy, they're at the core of everything and they run everything. That's catastrophic when you go to sell, because guess what? Then the buyer needs you to run everything. If instead it's like, you know what? I don't even have to be here because the systems run. You're in like Flint. Are they followed, or does everybody have an exception to the rule? And then are the systems able to support the growth of the company? At times, a manual system's great, but in order to grow, you got to automate. You got to update so you can actually leverage the growth. You want to read a great story? I'm reading a book on the history of McDonald's. You talk about implementing systems. That's how they built a kingdom, and that was the differentiator. So gave you some lists over here, but a handful of things is just assess the systems, fix what's broke. Market position. Walter alluded to this too. In some senses, it's why are we different? Why do people buy from us as opposed to somebody else? Because that is key, and there is a reason. If you're successful, people are buying. So what is it that drives people to you? You want more of that, and you want to highlight that more. I'm going to touch on these two next, and sustainable revenue. Just a simple idea. Are we easily replaceable? Have we become a buggy whip factory, or is there something unique about what we do that no one else can do? What's our secret sauce? Which is key. And then little thoughts here on just product differentiation. What makes the product different? I skipped over these, and Walter alluded to them, but just simple hit the nail on the head idea. Diverse revenue. The company on the left, if 90% of your revenue is with one client, well, guess what? Massive warning bells for a buyer, because the simple question is, what if that person leaves? That client gets tired of you. And unless you've got a in perpetuity contract in writing, it's super high risk. Company on the right, far less risk. You lose 10%, totally recoverable. Another concept that's massively valuable is recurring revenue. And that's where I subscribe. There's some, like, one of these funky channels on Amazon Prime. I couldn't figure out how to unsubscribe. It took me like a half hour to get to it. Brilliant on their part. Recurring revenue, they kept billing me. I tend to forget about it. And when you start doing that a million times over, you're talking real money. So anything that is recurring is actually a much more valuable concept. And this simple picture, just the numbers are irrelevant, but the point is, if it's 100% new sales every year, to grow it, you got to sell that much. If it's 70% recurring, guess what? You only have to sell a third of that, or 30% of it. Just the amount of sales that need to occur are obviously much less. And that hits a chord with a buyer, both from the, wow, what's my effort going to be to run this, but also how sure is my future revenue? Because if you got the recurring revenue, it will lend confidence to what you're saying. Cash flow, again, we touched on this, cash flow and financial controls. It's great to have great numbers, but when a buyer asks, hey, can I see your financials, and you can't produce them, major warning sign. There's no confidence in the numbers you're presenting. So just a handful of the, block and tackle stuff. Do you have an annual budget that projects growth, expenses, et cetera? Are you actually managing cash, and are you aware of cash management? And unfortunately, a lot of businesses, they run their business by cash in the bank. That's not cash management. Instead, it's got this much in the bank, where are we going to be at the end of the year? What do we need to spend over the year? And that relates to forecasts. What's going to happen in the future? And again, I've been forecasting for 35 years and I do not have a crystal ball. On the other hand, I'm pretty good at educated guesses. And that's all forecasting really is educated guesses. But, you know, even if someone's not comfortable doing it, they got to do it and they'll find they actually can do it. Reporting, just are you cranking out the numbers at the end of the month and looking at them? Are they consistent the way you report them? Because if a buyer can look at your numbers and see the same account structure going back 5 years and analyze them, it gives them confidence in history. If the chart of accounts changes, you change the reports, you don't really do reports, etc. How's the buyer going to have confidence in your history, much less the future? And then an analysis. You know, we create budgets, and again, budgets are guesses. So the issue isn't that you miss a budget. The issue is that if you miss a budget, you know why. You know, and there's nothing wrong actually deciding to deviate from a budget because you're the manager. You should do that. On the other hand, you got to be able to answer the question why. So as a guy that's been budgeting for 35 years as well, that's the key issue, is not that the line for budget, line for actual diverge. The question is, well, it diverged because we made a decision to do this for this reason. That's good management. Okay, so, but doing those 5 things really is essential, I would say, to say, yeah, you actually have good financial controls. Would you add anything to that, Walter?
No, I think that's exactly right. And goes back to, especially if you're hoping to sell based on a future cash flow model, you really need to be able to show that you're on top of your finances.
Yeah. And just a little asterisk, you know, Walter's actually a rare breed of CPA where, you know, Walter really is, he gets how businesses function. I'm a business operations guy, not a CPA. And this is business operations stuff, not accounting stuff. And all too often I've run into business owners who say, well, that's what my CPA gives me. Well, then either find a new CPA or find somebody that can actually give you management information that's meaningful to you. Because if the numbers aren't meaningful to you, then it's just data. It's not information, and you can't act upon it. Because again, that's the point of financial controls, is acting upon the information they provide and validating that your plans are actually happening. They are your scorecard. The fifth driver is growth plans, and Walter alluded to it, you know, particularly if you're a new company, but even if you're a mature company, you want to be able to project what you hope will happen and hope with hopefully an educated plan to attain that hope. And it's not hard. It's grow the top line, grow the bottom line, decrease the risk, increase the multiple. You know, and so again, when you think grow the top line, the simple question is, well, how much could you grow it? If you've grown it at 10% a year without really planning, how much could you grow it? And it leads to the question, how are you going to do that? Guess what? That's a strategic plan. You know, just answering that simple question, what would we do to grow by 10%, will actually move you in that direction. So multiple benefits from here. One, it makes it purposeful, lets you put a finger on what the keys are to growth, and a couple other data points. A larger company is less risky than a small company. So in a way, bigger is better. The multiple actually goes up as companies get larger because risk goes down. And you can actually start projecting. If this is a simple analysis here, but growing at the rate of inflation over 5 years, this company would go from 1.2 to 1.3 million dollars in value. If we grew it at 10%, it'd go to from 1.2 to 1.9, 49% more. And if you went another 5 years, it would go north of the $3 million mark. So purposeful growth over time, just like investments in a portfolio over time, yield tremendous value over time. And then that lets someone like Lisa say, yep, if you can keep doing that, you're going to be okay at the end of it. Not only that, Walter mentioned it, but boy, if you can show for the last 5 years, we made a plan and we nailed it shut. Now, if I present a plan that says, in the next 5 years, here's what we're going to do. If nothing else, I'm starting at a much higher negotiation point because I can start 5 years out and say, now this thing is, even though we're old, I want to lean on that discounted future benefits and say, boy, we're worth this much more. So, yeah, I'll stop there. Next steps, Lisa.
So a lot of great stuff here that we've thrown at you for today. This idea of focusing on getting a benchmark. If you haven't gotten an estimate of value or you haven't had a full-on valuation of your business, that is a critical next step. You can't improve something you don't know where you stand on. So we can't say that strongly enough, is that you've got to understand and get a number on the value of your business, just like you've got to have a clear sense of what you're looking for personally, financially. And then when we've got that gap, we've got to understand what represents that gap, how big is it, how easy is it to deal with, what are the drivers of my business, what could I tweak to improve the value to close that gap. And obviously from what we heard from both Walter and Corby, there's a lot of different factors to take into account. And one thing I would say is that you trying to judge how to make these improvements objectively is really tough. Business owners are not great at objectively assessing where the holes are, what needs to be fixed. We often have pet projects, pet employees, and you really need that outside objective look at what's driving the value of your business, what might need to change, what will it take to do that. And I think the other piece that became clear today is how important it is to have strong financial management in your business. You've got to have good books and records. You've got to be looking at your numbers regularly. If you're not good at that, you need to get some help with it. And even if you are decent at it, I can't believe that's the main thing that you should be doing, and that's where you add the most value to the business. So getting somebody on the team who can help you assess the financials of the business, and if you haven't started to build growth plans for the future, that's obviously critical as well, because what a buyer wants to see is how well have you done in the past, how strong are your numbers, how predictable are they, and where are you going in the future? Is this something worth buying? And so, as we continue to talk about here, even if you're a small business, it's important to make the investment, and I say that really clearly, versus the expense of having some strong team members, having an accountant, having financial management, a part-time CFO, somebody who's really helping you with that piece. Obviously, having some analysis of where you are personally and where you're trying to go financially. And then having somebody who can assess from the outside, how good is your business? Where are the holes? What needs to be improved in terms of people, process, and product, as Corby talked about. So that's really some of the things we want you to be thinking about this summer. We will be sending out another follow-up email. We're going to send out some materials and some questions for you to think about. So the next 2 months are going to be a time to read, to think, to discern, perhaps start taking action, so that as you come back in September, which tends to be that, back to school, ready to go time, that you're really ready to think about, what is my best exit path? Where do I stand currently? What are some of the things that I need to start planning for from a wealth and estate and tax planning standpoint? And what does the best version of my business look like? How am I going to truly make it sellable? What's my game plan for that? And so we're going to be pulling everything together. But this summer, we're going to be sending you some articles and some things to think about during what we think is a good time to hopefully get some downtime to rest and rejuvenate as a business owner before things pick up in the fall. So those are the dates. Mark those. We will send those as part of our follow-up as well. We welcome your questions in a moment, but we also welcome you reaching out to us if you've got any individual questions about your own circumstances. So let me stop there for a second and just see if anybody's got any questions. I don't know if we had anything in the chat. I wasn't paying attention. I don't see anything in the chat. Anybody got any questions? And just make sure and take yourself off of mute.
Lisa, I had a direct chat question. So someone was just asking, they're familiar with like rules of thumb from a valuation standpoint in their industry. And the question is, are those reliable?
Mm-hmm.
And, I think Corby and I both use those when we do estimates of value really as a sanity check. But they can certainly be valuable. I know like in the CPA world, the general rule is that CPA firms sell for 1 times revenue. And that, generally holds true. So you could start with that as your base, like for CPA, for example, you could start with that as your baseline. And if there's certain reasons, like let's say that you're a forensic accounting firm, you're going to be more profitable, which may give you a higher multiple. But then again, you also don't have that annuity work necessarily. So depending on where your work is coming from, how solid, referral relationships are, you may have a really good multiple. If you're a tax compliance factory with very low margins, you're probably not going to sell for one times. So the answer to the question is rules of thumb are a good starting point, but your business is going to be, probably not valued strictly based on that.
Well, and I think you need to get an outside objective look at it, because same is true in my industry. There's a whole range of multiples, and you're going to want to take the big one, right? You want to take the one that's 2.5 times, not the one that's 1. But maybe that's not your business currently, and maybe you've got some work to do to get it from one time to 2.5. And you also need to understand what the multiple is against. Is it against cash flow? Is it against revenue? So again, don't try to be an expert on this, and get an objective look, because the worst thing you could do for me, if you're working with me, is that you're making an assumption your business is worth 2.5% or 2.5 times. And it turns out when you actually get an estimate of value, it's worth 1. Now I have a huge gap I'm trying to solve for with you. So it's really important to get an objective look at each of these different aspects of the 3-legged stool.
Yeah, I had the thought as Walter was talking about rules of thumb, even, when you have a home in a neighborhood, the bones tend to be generally the same. And in a way, the comps in the neighborhood kind of drive it. You can have a nicer kitchen, maybe a minor differentiator. Business is actually the inverse. CPA firms, you name a type of firm, there's a real danger in assuming, same bones, because they can be so radically different. And to validate that they are indeed the same bones, particularly for smaller companies, is almost impossible because the data is just not there. So that's why it's a rule of thumb. The most weight I ever give it, maybe 15%, if it really is a pretty standard type of service industry, but not a lot.
Hey, Walter, do you want to tackle Kelly's question?
I don't see it.
Well, so the question is, in your estimate and experience, what is your rule of thumb for how much of the price is paid out on day 1 versus paid out over time?
Yeah, so that's going to depend a lot on how the risk that the buyer perceives, obviously. I had a client recently, very strong government contractor, and they just sold off a segment of their business and they got 90% upfront. We've had other clients who were not nearly in that position and they got 50% upfront. I can't think of a time where I've seen less than 50, but so I kind of think for most of our clients, probably 60 to 75% range cash up front would be pretty good.
I can tell you in my industry, that's not how it's done most of the time. It's a smaller down payment and then a note. So
Yeah.
again, this is why you need to talk with a professional, because if you're thinking it's like the lottery and you're getting a big check, and then and your planning doesn't support the fact that it's going to pay out over time, that's a huge problem. I think the sooner you're trying to get your money, the trade-off, there's going to be a trade-off of value. If you're willing to take some of the risk as the seller to spread that payment out, you potentially can get more. But as I talked about in one of the earlier sessions, you got to bank that money. If you spend that money, when you get to the end of the payment, the note payments, if you don't have anything to show for it, that's not going to work.
Yeah, and there's just another thought is there are notes and then there are earnouts, and they're different. That at times in a sales price, say for the sake of argument, it's $10 million purchase price and it's a 60% upfront. A 40% note generally says, okay, well, we're going to pay you out over 5 years. And the governing issue there is, will the business remain profitable to pay its debt? Because it's a debt it owes you. And earnout says, okay, you're going to stay on board for 3 years and the company will hit these numbers. And if we don't hit these numbers, you don't get paid. There's a twofold downside to that. One is they control the accounting now, you don't. And they can decide to adjust those numbers if they'd like. And secondarily, you've just gone from owner to employee, which, in most cases, there's not a real hard stat, but most owners don't ever stay on board for their earnout because it's so miserable. It just, because that's not who you are. And so just know that as well.
So then that money's potentially gone, and that was part of your plan. And now we've got to make adjustments on the financial plan. So there's a lot to think about. All these pieces fit together. The key is not trying to do the math yourself, because often you're going to be generous. And it's probably not going to work out the way that you expected. And I'm not trying to be negative. I'm trying to be objective, because our goal is, of course, for everyone to have a really successful exit transition.
Yeah.
And Lisa, the only other point I would add to that discussion is, and we're going to be discussing it in September, is the exit path that you choose is going to impact how much cash you get up front also. So, if you're selling to insiders, you're probably going to get the least amount of cash up front. If you're selling to a venture capitalist or outside third party, you'll probably get the most cash up front.
So Walter, that leads into the question I wanted to ask, which is, how does your evaluation of the company change if the sale is to an insider versus, just to anybody?
So that's a really good question. The the value of the company itself doesn't really change, but there's a couple of dynamics that come into play. One is from a tax efficiency standpoint, it's beneficial in a sale to insiders to use what's called the lowest defensible value. So the money that the buyers pay you for the company has the least tax benefit to them. So if you can reduce that value and replace it with some type of deferred comp, which is fully deductible by the buyer, that's a good strategy. So while the true value of the company isn't changing, the way you're kind of structuring the payout of that value is going to change to take advantage of the tax laws. So I think that's kind of the answer. The value doesn't change. The way you're going to receive it might, and the period of time that it's going to take you to collect it will certainly change.
Well, and wouldn't you also, often there are discounts. I mean, that if you really want your team to take over, and maybe that's the same thing that you're saying as far as the lowest defensible value versus an outside and external sale, that you are often, that's a trade-off you're making.
Yeah, for sure. Oftentimes, if it's a sale to insiders or transfer to family, there's going to be, usually the way those strategies work best is when the buyer or the seller does not need to get top dollar for the business.
Yeah.
In those situations, you can take some heavier discounts to reduce the value they need to pay you, and strategies like that.
Yeah, and if I could chime in there, we've had the pleasure of working a couple of insider sales, and having a good financial analyst like Lisa, a financial advisor that says, here's what you need, that becomes kind of the end goal, is what type of cash do you need over time? And then there are all kinds of deal structures which enable somebody to transition out. An owner can do a 50% sale, for instance, because often insiders don't have cash to buy. And it's the cash flow of the company that's actually going to fund the purchase. So you've got to think through, how do we enable them to acquire while meeting our goals? And there are still strategies of retaining a part-time employment status, retaining part-time ownership, so deal structure that Walter alluded to a couple sessions ago, that is huge in actually hitting the end goal that Lisa has defined. And price is part of that, but there's all kinds of other avenues to hit the number.
And the last thing I would say is that some of this comes down to not money at all. It comes down to,
yes,
what do I really want to achieve? I want to keep this business going. I want to keep it in the hands of the people who worked so hard to build it. Or maybe that's not the case. And so you've got to have some clarity on your end game from a values and an emotional standpoint. And then there's the financial piece, and then you got to figure out how those go together. And then, of course, there's the business value and where that fits in. So it's really important to discern, if I'm on the other side of this transition, what's going to make me feel good? What would be the best result on the other side of this? And unless you've got clarity on that, you're going to be spun all over the place as far as exit paths. What's the right number? How long do I have? What's the right, number I need to get? So that's a good thing to think about this summer, is really to discern what would be the best result for you and for the business in the future. Because if you don't have that clear, a lot of this gets pretty foggy. So we're close to the top here. Any other burning questions? Otherwise, feel free to reach out to us, and maybe, we'll send our email addresses again so you can reach out to us. But any other burning questions? Right. So we look forward to seeing you in September. Have a great summer. Get some rest. Take some time to think about some of what we're going to send to you. We really appreciate you joining us for the last few sessions, and look forward to seeing all of your faces again in a couple of months.
Thank you.
Bye, everyone.
Hi, everybody. Thank you.
See you later.
Thanks.
Thank you.
Bye-bye.
Bye-bye. So, hey, guys.
I know you got to go. So why don't I get a draft of an email together, and you can take a look at it and see what else we want to have in it. And then I'll send some dates and times for next week, if we could get, just a few minutes to talk. Okay.
Perfect. Good.
Thanks. Bye.
All right, thanks, guys. Bye-bye.